Good morning, everybody. Welcome back to Morning Markets on Monday, the 8th of June. Firstly, I'd like to discuss the US jobs report from Friday. Why? Because it was so different to expectations. And by that I mean, we discussed last week, if we cast our minds back, an unemployment rate expected to be in the region of 18 to 20%, with an additional 7.5 million people joining the claimant count. What did we get? We got a record positive month with 2.5 million jobs added and an unemployment rate at some 13.3%. Significantly different from what forecasters and economists had been thinking. Some 10 million difference if you take it between 2.5 million positive and 7.5 million negative. So why was the difference so large? Why were economists, forecasters so out with their forecast this month? A couple of things that I think are interesting in that regard, and two of them we touched on last week, the ADP jobs report and the initial claims report. They are presenting information that is slightly conflicting with the Bureau of Labour Statistics data that we saw on Friday. So that's something to note. We also saw quite significant revisions to the data from March and April within the May report, so there could be revisions coming forward. Nevertheless, it is an unemployment rate that is 13.3%. It's a high number given only 12 weeks ago we had record low unemployment of some 3%. So there's a lot of jobs to need to come back to the economy to get us back to the position that we were previously. But clearly we're not from a starting point of 20%, we're from a starting point of some 13.3%. So that's a positive, and clearly, as you would expect, the asset markets were surprised by this. What did we see there? We saw strong moves from the Dow, S&P and the Nasdaq. But more importantly, we also saw strong moves from the economically sensitive sectors such as transportation, industrials and financials. And that continues to build on the trend that we've been noting over the past week to 10 days of strength in the more economically sensitive areas, so they outperformed the broader market. We also saw quite significant moves in the bond market with sovereign bond 10-year yields and 30-year yields selling off, so the yield increasing there. The yield in the 10-year rose to over 90 basis points and closed the day at 91 basis points after hitting a high of approximately 96. So quite a material move in the bond market over the course of the week, a 24 basis point move in the 10-year Treasury in the US. So the yield curve has very much steepened in the US over the past couple of days and indeed weeks. That's also historically been a positive signal for the market and also for some of the more economically sensitive sectors, in particular the financial sector. So that's something again that we'll continue to monitor. Turning now to the week ahead, what have we got there? Well, we'll hear from the Fed this week, and I think in the context of the jobs report, that's going to be really interesting. Why? Because of the movement that we've seen in the Treasury market. That's important because that's the rate that the government will have to pay to fund the borrowing that they've made to support the economy through this difficult period. But also it's a direct impact on borrowers as well. So as yields back up, borrowing costs increase. So that's something that will be interesting to see if the Fed mention that at all. We also have Christine Lagarde speaking at the European Parliament as well today. That'll be interesting to see if she continues to push on the need for a much more coordinated response at a political level in terms of the fiscal support programs that are required. So a lot of interesting developments over the past few days in markets, and particularly the jobs report. We'll have interesting data points over the coming week. So please join me again as we'll be looking at those in the coming days. Thank you.